So DealQuest listeners, I am unbelievably excited to have Marcia Nelson on the DealQuest podcast. She has so much diverse experience in the deal space after not knowing what a deal was when she was a little kid, right? But, the things she's done are amazing. So Marcia, tell the folks a little bit about what they're going to hear on your episode of DealQuest.
Oh my goodness. Thank you, Corey. Well, I'm so excited to be here. You can hear a little bit about my journey. I'm very open and happy to share where I started and where I ended up. But I'm really excited to share some of my experiences working in family offices and family office deal making. And also I get to talk a little bit about some of my favorite subjects. I'm on the board of ACG-NY, and I get a couple of plugs in there about ACG and deal making. So very happy to be here. And thank you for this incredible honor.
Yeah, so folks, a lot of the things that she talks about is some of them are specific to family office, investments and families, but, a lot of them are also just generally about what's going on in the deal making industry, right? We talked a little bit about, manufacturing and, the evolution of energy and things like that, right? So there's
a little bit about impact, right? We talked about impact investing.
Impact investing. Yep. Totally. So, I think there's some great information on some trends that are going on that, that affect investing in general. So folks, definitely check out Marcia's episode on DealQuest coming up soon. Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. Marcia Nelson is a managing director at ShareNett, a members-only global network of professional investors collaborating on curated quality investment opportunities. She spent a large part of her career working in and for family offices and private deal makers. Over the last 20 years, she has developed a strong network of private families, institutional investors, and advisors who are increasingly seeking access to direct quality lead flow from trusted, experienced partners. She has served on numerous boards. She's also involved with the CCC Advisory. You can see all this in the show notes. One of the other places that she's involved is at the association. She's the president of the Association of Corporate Growth, which focuses on driving middle market investments. And she's also a board member of venturecapital.org, a nonprofit early startup stage accelerator. So listen, definitely check out her bio. It's super impressive. She's won some phenomenal awards, been in Who's Who, et cetera, et cetera. I am so excited to have Marcia on the DealQuest podcast. Marcia, welcome.
Great. Hey, Corey, nice to talk to you today. I'm here in rainy New York City. Jealous that you're in sunny California.
It's funny because it's been a little cooler out here, meaning that it has actually gotten down into the high 50s at night. And I laugh being a New Yorker because people out here start, wearing winter coats when it hits the 50s. It's kind of funny. So Marcia, I want to, before we talk about all your amazing, deal experience and everything you do and now and you've done in your career, I want to take you back to when you were growing up as a little girl, 8, 10, 12 years old. Because my guess is, and I want to know what you wanted to be growing up, because my guess is that it wasn't somebody doing deals and in financial services and related spaces. That's my guess, but I could be wrong. You tell me.
No, you're absolutely right. My dad was in construction and my mother was a teacher. And I thought I was going to teach English for my entire life. That's what I thought I was going to do. Didn't really know anybody in the deal space. Didn't know what a deal was. That wasn't, I grew up in Salt Lake City, Utah, and we were not in any way, shape, or form in financial services. So it wasn't until I moved to New York with my fiance after college that I really learned a little bit about the deal community. And I jumped in about 10 years later and have loved it ever since.
Love it. And what did you do in that 10-year gap in between moving and jumping into the deal space?
All right. I taught high school for a couple of years, and then I became an executive assistant and I worked in the fashion publishing industry. So I lived the Devil Wears Prada life. I was at YM and then Mademoiselle magazine. And it was so much fun in New York City. That whole Madison Avenue period was fabulous until it wasn't, until the merry-go-round stopped when .com came along and print magazines started to disappear. So It's when I went back to graduate school and got an MBA.
Love it. And so what was your first major deal that you can think of any type? It could be some, deal you did when you were young, or it could be your first deal when you really, in your professional career. What comes to mind?
Yeah, the first deal I worked on was an ESOP, employee stock option plan, for a valuation firm that I worked for. And I knew nothing about ESOPs. And that was certainly a deep dive for me to understand the complications that come with that, with the trustees and the employees, but certainly some real advantages to that for certain companies. I think UPS was one of the first big companies that I'd learned about, that was going through an ESOP. So that was really, really fascinating. I don't see too many of those right now, but certainly there was a period of time when those were really popular.
Yeah, no question about it. Yeah, I think they've definitely slowed down a lot. I remember that time when it was the ESOP time. So, we heard some of the cool stuff you're up to in your bio, but before we get into more specifics around the deals, just give us a couple of minutes on really what you're doing now and who you serve in your core business. And then I want to hear a little bit more also about the Association for Corporate Growth.
Yeah, thank you. So I'm a managing director at ShareNett, which is really a boutique investment bank, private placements for family offices and high net worth individuals. So our role there is sort of traditional investment banking in terms of some M&A advisory and certainly deal sourcing, but our niche is really finding deals from family offices and partnering and clubbing them with other families. So we say we're by families and for families.
Right. You have a family office, they're investing in a particular deal, they need some other capital, and you're going to raise that from some of your other family connections who will get in as part of the deal, right?
Yep. And they look to us, depend on us to do some diligence and screening and sort of sift through some of the noise, because you can imagine a lot of these high net worth families, especially if they're known in the industry, they get pitched a lot. And sometimes They just need help sort of filtering through all the noise and finding the right opportunities for themselves.
What's the typical deal size or range, and deal size that you guys get involved in?
Yeah, so generally we like to start around 10 million, although we're currently working on a deal that's in the 5 million range. But when we can be additive and be really helpful somewhere between like the 10 to 100 million. So we really are in the lower middle market space.
Yeah, sounds great. Good. So, and we'll talk about some more specifics about the kind of deals. Talk to us a little bit about Association for Corporate Growth, which you're the president of now.
Yeah, so I'm a president of the New York chapter. There's 59 chapters, I think, last count, around the globe, most in the US, but I'm president of New York. I've been involved in the organization for several years and been on the board for, I think, the last 7 years before I became president. And ACG is really a deal-making network, and it's there to help facilitate middle market deal-making. So we have a fair number of private equity firms and investment bankers. And then we have the transaction advisors around that, including the lenders, attorneys, accountants, all the people that you need to help you get a deal closed. And we started a family office chapter committee. We started a family office committee about 5 years ago, and they've become a really big part of the ACG New York network because family offices are doing many more sort of those private equity type deals, on behalf of a single family or a small group of families.
That's interesting. I usually start broader and then get more specific, but I think I'm just going to go the other way this time.
Okay.
So what are the specific issues? Obviously there's a lot to talk about in terms of any kind of investment deal by anybody and all the things to watch out for and the best practices and the big mistakes people make. Let's actually start. What are the specific things that come up that are different in family office and family type investment deals compared to some other stuff?
Yeah, well, there are a couple of things. Like one in particular, I see a lot of family offices that are being driven by the second or third generation that are really interested in impact investing.
Yes.
So I spend a lot of time talking to families about, opportunities in that could be everything from like life science, healthcare deals to food and agriculture technology to help food and ag be more sustainable, green energy. Early days, it was wind farms, and now it's all sorts of other technology that can support us shifting away from fossil fuels. So I see that a lot, and I think a lot of that's been driven by family offices, that whole ESG impact. And then just generally, for most family offices, a lot of families made their money in a particular industry. So they tend to focus on those industries where they think they already know that they know the business and they want to find another opportunity in that business. So unlike a private equity firm that can be much more general and have multiple sectors, most family offices that I know have very specific sectors that they like to invest in, or that's why they do club deals. Like that's why they'll work with a company like ShareNett, because they rely on other families to do the due diligence for them.
Right. They're trusting the lead investors do the diligence and come along, and there's an opportunity to capitalize on that. Yeah, it's interesting to me on the ESG point because we don't spend on politics, on the show, but yeah, obviously the whole alternative energy versus, it's a big issue in this election, it's a big issue politically. But I think, we're not going to discuss that, but just from what I have seen in terms of the move and a lot of the I have a lot of clients in the investment advisors space, some of them specifically focus in ESG and socially conscious investing. Some of them at least have portfolios, within, if it's not all they do. And certainly, as I see next generation, like you said, it's much more of a focus. And I just sort of feel like, and I'm curious if you see this way as well, outside of all the political wrangling and everything else that goes on around it, I just think there's a demographic shift of, younger folks who that's just much more important to. So it almost seems inevitable to me that trend's going to continue.
Yeah, I think you're absolutely right. And I definitely think it's a shift as the younger generations, it starts to inherit wealth and starts to have more control over where their family money is going. I also think that there was always this philanthropy side for some of the larger families. I think the investment side has sort of caught up with the philanthropy. So I think a lot of that's driven by the second and third generations. They're saying, wait, we're putting all our philanthropic dollars in saving the ocean, but our investment dollars are polluting the ocean. There's sort of a mismatch there. Right. So I think the younger generation is saying, gee, why can't we align both of those instead of being on parallel tracks? Let's kind of like get them closer and closer together. And I think that's really another area that's really driving that, bringing those philanthropic dollars alongside the investment dollars.
Yeah, and I agree. And then I think there's this, even this concept of socially conscious business. I mean, there's a lot of folks that I know. I mean, my wife and I have been very involved in this movement and actually moved from having our own nonprofit to focusing on more socially conscious business, where you can actually make money and do good and not be relying upon, funders that cycle out. And I think actually a lot of the nonprofit model, especially on the grassroots level, is not very sustainable. And I think there's a definite move, not that I'm anti-nonprofit in any means, anti-philanthropy in any means, but I think this is third thing that's sort of in between your straight for-profit, company and your, which is, like these B Corps and basically socially conscious companies that are not just giving a percentage of their profits to charity as a marketing tool, but really have it as part of their core mission to make money, but also make a difference.
Yeah, I 100% agree there. And I also think that the ESG, however you define that, has shifted because it really did used to be a few years ago was like, be happy with a 2% return. And that's just going to make your real money in these bigger corporations. And I think there's been a real shift away from that as well to say, wait, we can make more money. We can make just as much or more money in an ESG strategy. Some of that's driven by diversity and minority owned businesses and founders and more diverse boards. And we've seen that those have much better results. Just generally, the numbers speak for themselves. I really think there's a shift there that we don't have to accept lower interest rates and a lower return because we're going to make money in the long term. And it's going to be better. It's a win-win, I guess is the word I want to use. The words I want to use, win-win for everybody.
Yeah, I've seen that as well. Yeah, I mean, you're exactly right. I mean, people used to say, okay, it's sort of like half investment, half philanthropic. I'll accept a lower return to be able to do good. But now people are, you don't necessarily have to do that. And it's actually broadened the market because if somebody can do good and also get comparable returns, then, it's great. Excellent. What other things are you seeing out there in terms of any, sort of trends or focus areas or, what are you seeing in the market?
Yeah, I've definitely seen an interest in manufacturing industrials and bringing manufacturing back to the U.S. I think a lot of that is not driven by politics. I think a lot of it was driven by the disruptions in the supply chain since the pandemic. Yes. And all of a sudden, I think there was a big awareness that, whoa, I may be able to put, this Coca-Cola can together, but I'm missing like one little component and it's stuck on a boat from somewhere. And so we're definitely seeing a shift in those kinds of businesses. And some of those businesses are just being repurposed. So I've seen a lot of companies in the short term say, wait, we can manufacture PPE equipment if we just shift our focus a little bit. So I think there's a lot of drivers, especially over the last 6 months. But I think some of that might be here to stay, that the supply chain issues are never going to go away. I think we've just become aware of them. Surprise.
Yeah, I think that's a great point. I'm seeing that as well. And but I'm also, and tell me if you see the same thing and feel free. I mean, I always said, yes, I really mean it. Feel free to disagree with me if you're seeing something different or you have a different view. I think you got to make some distinctions, right? Because a lot of times when people think of manufacturing, they think of huge, big steel and coal and, whatever. And, what I'm seeing at least is, first of all, you got a lot more sort of very niche, more high tech, more new industry, more focused and agile manufacturing where there's, a lot of money and growth and innovation going into, which is very different than, bringing steel back. What are you saying?
No. I absolutely agree. I think it's more product focused, whether it's like consumer products, sheets and bedding and mattresses, and, companies are doing really well. Certainly the companies that are puzzle makers and game makers, because here we are, everybody bought a puzzle and everybody bought a bike, like some of those things, those are sort of short-term manufacturing issues. I think that there's going to be more and more interest, especially a lot of people moved out of the big cities. I live here in New York, and in the last 6 months, we've sort of seen a lot of people moving out of the city. And I think that might also drive investments in their local communities, because you're going to have smart people who understand deal making, who are going to say, wait, like why can't we build that in our backyard? So I think that will be a long-term demographic shift. And that's like, the crystal ball, according to Marcia.
That is an interesting trend, right? Like, I think, frankly, my wife and I have been, we in normal times split time between the New York area and LA, Marina Del Rey, and we love both those places. But, with everything that happened like this, and I know a lot of folks who like this, we're thinking maybe we should have at least one of our places like outside of a major metropolitan area, like in the mountains. So we're actually, we're in the early stages, so we're actually like going to Boulder, Colorado in a week or two.
Yeah.
We take a look around there. We know a lot of folks there. And I know a lot of, and listen, obviously, let's be clear. We're talking about a lot of people in this country that don't have these options, right? But, a lot of folks who have some means and level of success and have found that, wow, this working remotely actually can work, are looking at these options, and they're, actually the real estate in a lot of these areas is predicted to go up despite maybe some challenges that might be coming, otherwise in the economy. And yeah, I think that raises interesting questions, right? Because if people are moving out of major cities, at least for a little while, on a deal with a major investment banker, who is in her place in rural Pennsylvania and has been there for, 8 months, so, it'll be interesting to see how that affects things long term.
Well, and maybe she'll see opportunities there too, that maybe that she passed over because she was so busy hopping from the hot metropolitan cities, right? So yeah. I think that's the other thing too, is something like it's so important. For years people talked about the flyover states, which I don't really think, I don't think there's really so much of a flyover anymore, because I do think there's a lot more happening, around the country that we have sort of diversified as a nation. But I do think we do sort of, even hit the hot cities or the top cities and not the smaller areas where there's still things happening there. And I 100% agree with you. Like, manufacturing doesn't necessarily mean coal and steel and big refineries. There's still things to be made, the widget factories are still really valuable.
Yeah, it's really interesting. And, and I guess, those of us who do spend a lot of time in big cities, it's such a service economy. It's funny. I did have a friend who used to own a company, and, I remember how fascinated we were in Long Island City, Queens, and he made acrylic furniture. And it was a family-owned company. His father started it. They actually used to manufacture in what is now the meatpacking. Well, it was always the meatpacking district, but back when he manufactured, they were actually meatpacking as opposed to, So, they moved it out of that building. Of course, that building became so valuable into Long Island City, Queens. And I remember we used to go there, and there were actually like machines, and they were actually making products. And it was like the most fascinating thing in the world for those of us who are city folks and mainly dealt with a lot of other people in the service industry. But, there are definitely parts of this country, a lot of parts of this country where that's certainly having manufacturing is much more common.
Yeah, I agree.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
Back to your original question about where I think the changes are happening, what's happening. I definitely think that technology, and I don't mean just computer tech, but I think technology in general is touching every industry. I think it's also making it easier to do more manufacturing in local communities because the technology enables you to have robots to go out to work remote sites and to monitor things that would have taken a lot of manpower in the past to do. So I think we really are in a technology revolution, and I think it's going to continue. But I think it's going to go beyond, your computers and your iPhones and really get into every little thing from monitoring. Farmers use technology now, satellites, to monitor crops and decide what they're going to plant and when they're going to plant. And I think we're going to see a lot more of that in the future.
Not to sort of buy into a stereotype, which may or may not be true for a lot of these families, but when you have multi-generational families who are investing, and you have the let's say the old guard, again, without stereotyping, more often less up on technology, and I certainly see it with the younger generation is like, we should invest in this thing, and the old generation is like, yeah, how many years they've been in business and how much cash flow they flow, so do you see some of those tensions in the investment decision making, and especially in families?
Well, the running joke is that, like, if you've seen one family office, you've seen one family office, right? Because they are all because they are all so different. So yes, I have seen some of those, but then I recently met a really nice family, 5th generation family, made a lot of money in oil and gas, and the 4th and 5th generation together have been really leading the charge for clean energy, and they made a personal shift. And so, and the family just supported it. And I don't know how long it took the 4th generation. I know the 5th generation. Sorry, I'm using too many numbers because I don't want to use their name, but they have been a huge advocate for clean energy. And they said, look, like, we're really grateful that we were able to make our money in a way that now that we can be sustainable. And they said, look, it was a different time. People made money differently, and we thought differently about the world, and frankly, like, it was really great to have electricity. It was really great to get away from, right? Yeah. Like we can't denigrate it. It's like, it was really great to get away from coal fire stoves, right? It was really great to have cars and airplanes, and all of those things are driven by, fossil fuels, but that changed the world. And so you can say, okay, well, like, we're moving beyond that, but I don't really think you can go back and say that was a terrible thing. It was a great thing, and it did a lot for us. And now we're just a little more evolved and working on the next thing.
Yeah, I love that point of view because, listen, at some point, fossil fuels were a great new invention, right? And it made a difference. You see the same thing with plastic, right? You see those commercials from the 50s where they were like, plastics, it's the new, whatever, and it was, right? And now, of course, we're finding out the environmental impact and lack of, and stuff like that. Things get demonized. And listen, I think there's some legitimate tension between how quickly, certain people want to evolve, and obviously impacting jobs and all that kind of stuff. And those are legitimate issues. But yeah, I look at it as, it was great for, the time we had it. And now there's other things that, when we've learned more and we learn impacts. And so, yeah, so I love that. I love that attitude. And I love the fact that some of those families are evolving. Great. What are some of the key things that you help these folks do, right? Because I know, you said you're helping them vet some of the, investments where they might not be leading. What other role do you play with those clients?
So I sit on 5 different boards, and, I sit on 3 nonprofits, and then I advise a family office, and then I sit on a for-profit board. And all of those align for me because they give me deal flow. So I'm sort of like the canary in the coal mine, since we're talking about the coal and fossil fuels, I can use that term today. My job is to go out and look for opportunities for these families. And it is a lot of work. And I know you know this as a deal attorney, that you spend a lot of time, and your clients probably spend a lot of time looking at hundreds and hundreds of opportunities before you find 1 or 2 or 10, whatever your number is, that you think are investable and are in the right stage for the right family. So my goal is really just to be out there, talk to a lot of people, get information that I can come back and share with my families. And then I do a lot of handholding. I spend a lot of time talking to my family office clients and my relationships, because their needs and desires change. And just like we were talking about the 2nd and 3rd generation. So if I get in and I'm talking to the 1st generation, they say, oh, I'm really interested in this. And then they come back from Thanksgiving dinner with their family and they say, well, we've decided that we want to do something else. And so it's really, really important to just be like open and available and be able to continue to have conversations as the families evolve in their thinking and their desires and what they're looking for. And then part of it is like part therapist, and not to denigrate therapists and put myself in their place in any way, shape, or form. But there is a lot of conversations around, helping some of these families come to me because they're looking for advice, or they're just looking for connections to other families. Especially, I had a family recently reach out to me, and they had a liquidity event last year, and they said, okay, now what do we do? Right? We had all this money. Well, they said, can you help us find somebody who can advise us so that our kids don't become trust fund babies. They were really concerned that all of a sudden they have this wealth and they didn't know what they're going to do with it. And then they also said, but we also know that, once the patriarch sells the business, you've got this almost like this pyramid. So the first generation is going to do really well, but you can't just go out and spend all that money without like rebuilding it. So then they come to me too and say, okay, like, can you help us figure out what an investment plan is? Do you have advisors and people? I don't do that myself. I definitely have a network of people that I refer them to. But it's like help them figure out like what that's going to look like, because they recognize that once the children and the grandchildren and the grandchildren get involved, like that money isn't going to last forever.
Yeah, I mean, it's just a math factor, right? Because most people have more than one kid. So, you end up exponential. And that's what makes family businesses hard sometimes, because there are more and more people involved, and they're more removed from the founder. You use the word, which is key in this stuff, which is, you get all these proposals, whatever, and you got to figure out what's investable. Talk to us a little bit about this conversation of investable, and what are the big factors in that for your type of connections and clients, and maybe some of the mistakes that companies make or the misperceptions they have. A lot of folks think they're investable and they're not, right?
Yeah. I think that like the two main issues that are are just complete red flags for me. And it's so easy to just rule these out. The first one is this a product or a company, right? So there's like two different things. Like some people are really good at making a product, but is that a product that they should then sell to, a Procter & Gamble and let the Procter & Gamble, the company, build it? Or is it a product that they really can build and scale, and then there's going to be, 50 other products that they can manufacture, if that's where they're headed. So that's the number one question that I ask. Is it a product or a company? Even if it's technology, is it a technology product or is it a company? Yes. And then the second one, and this is my like real pet peeve. I'm going to tell you my pet peeve. I look at a lot of decks and I get to the end of the deck and it's all like, of course, everything's rosy and their projections are really great. And you always discount them because you never believe their projections because it's going to end. Because because it's just projections, right? It's not that you don't believe it. They might be creating the next best thing, since Wonder Bread, but we also know it's going to change. But the biggest pet peeve is there's nothing in there about how the investor is going to make their money back. And that is my real question. I always ask, so I care about initially, my return on that I get my investment money back. Like the rest of it's gravy, but I just don't want to lose money. So I want to start with the baseline. You want to get me back to zero. And if I look through a deck and there's nothing in there about how they other than we're going to IPO in 12 months. And again, not a rosy, that's not the projection that I expect, but how are you going to increase your business and grow it so that I can get my money back? Is there an exit strategy? Is there, is this going to be the last round of financing? And if a founder or, whoever is making the presentation can't articulate that, that's just a real red flag. I'm go back, figure that out. Because otherwise, if you want me to give you a grant, then you should ask me for a grant. But if you're asking me for an investment, you need to consider what those terms are and how I'm going to get my money back. So those are the first two things that I just are so easy to just eliminate potential investment opportunities. Yeah.
Let's say they pass those two hurdles, right? They're smart enough to, have a pitch on how they're going to get the money back, and they've handled the first concern you raised. Then what are the kind of returns that investors are looking for? What are the kind of businesses that are likely to do that? I mean, it's so funny because, and I've talked about this before on the show, obviously we all, this idea of you're going to start a venture and raise capital and then go public, is seen as the ultimate, right? And, what percentage of businesses actually really do that or even should try to do that?
Yeah. Well, if you look at the venture capital model, their model is a third are going to make money, a third are going to be steady Eddie, and a third are going to go under. So one question you should ask as an investor is, do you have the stomach for that? Do you have the stomach? If you want to do the portfolio approach, can you build 20 companies knowing that 3 of them are going to fail, right? And if you don't have the stomach for that, then you should really just invest in a fund and let the smart people do it, right? And who have the stomach for that, right?
Yes.
The other thing I talk to my family office clients about is what are you really prepared to do? If you really want to be involved in a company and you're going to lean in and help them grow, that's great. Versus you want to be a passive investor because you want to be skiing in Switzerland or you want to play grandma or grandpa. There's different risk tolerances and there's different tolerances for how involved you need to be. So those are all big questions on the investor side. On the company side, what I often look for, not specifically sectors, just generally, a really good management team.
Sure.
And that could be, the founders, co-founders, but also who's on their advisory board. Is there anybody involved who has taken a company and sold it before? Is there anybody involved who has worked on companies that have failed and they know how hard it is to work? Those are really at the end of the day, depending on where, if you're investing in, I guess I'm talking early stage companies here. If you're investing in early stage, the 1 to 5 million, 1 to 10 million, you're really investing in the management team. Can they pivot? Can they make changes? Do they themselves have the stomach to, go the distance? So those are really, really important. Really sort of you take, art versus science kind of messages.
Yeah, those are great points. You said, and I've heard that expression too, that, when you've seen one family office, you've seen one family office, they're all different. So I'm sure that applies somewhat here, but do you find that the family offices are, what stage are the most of them investing in? How early, how late? Are they doing seed? Are they doing Series A? Are they doing seed? Is there any majority, or are they all over the map?
Well, in the last 10 years, since post-2008, a lot of the family offices that started going into the investing side really started because they got hurt in the market, and they said, wait, I'm smart enough, I can do this myself, right? So post-2008, we saw a lot of family office say, oh, I can just hire smart people, I can just do this. And then we saw that over the past 10 years, there's been a little bit more of a shift to say, well, yes, I could do this, but I really have to hire a lot of people, and it's not that easy. And I should just go in funds, but maybe there's another, maybe I funds, or maybe start a VC or private equity firm and hire people. So there are definitely families who invest early stage, who will do the friends and family rounds, and who really like angel and VC investing. Where I spend most of my time is talking to those that really look like private equity firms, that they have built a team around them. Maybe they hired somebody out of private equity. In fact, I know several family offices that are the founders of private equity firms who decided that they wanted to put, they made money on the PE side, and that company is doing well, and they want to invest more themselves personally. I mean, I think this is public information, but David Rubenstein is a really perfect example of that. He made his money in Carlisle, and then he started his own family office, and he's very careful not to compete against himself. And he and his family office really does more venture capital investing. But, so he's he's somebody who's kind of sort of shifted, his personal focus versus his business focus. So I definitely think we are seeing more institutionalizing of the family office. And I think that's the right way to go. And I think families are much better served by institutionalizing their private investments, and even if they're doing it on their own, because then they can get the right people around them. They can attract the right investments and the investment opportunities, and they're not just getting shown everything. It used to be family offices thought of themselves as dumb money. Everybody was, they were like, I've seen this deal 10 times because everybody thinks I'm just going to write a check. Right. And I think the families have gotten much more sophisticated in the process. Yeah,
no question. And I've seen them definitely move up market, more PE and, more professional. And it's interesting. This guy, I remember years ago, the dumb money was supposedly the doctors, right? When at the time, before medicine became a little, I mean, they still do pretty well, but before it became a little tougher, they were always the ones hey, find a doctor, they'll write you a check. They won't, and it was it was somewhat true back then, but they changed
absolutely.
as well,
They were like investment pools. They were investment pools. Like a bunch of doctors in a practice would get together and put a pool together so they could pool their resources. And absolutely. That was a very popular strategy, 20 years ago, even 10 years ago. Yeah,
exactly. They've sort of changed. So Marcia, before we close, and I give you an opportunity to let people know where they can reach in and ask you my last question. Any final thoughts on, anything you're seeing out there you think would be valuable for our listeners? And you don't need to, but if anything comes to mind, I want to give you an open opportunity.
Yeah, thank you. Well, I'm going to put in a plug for ACG, Association for Corporate Growth, just in terms of if anybody's interested in learning more about deal making. ACG has some great, free webinars, conferences, that anybody can participate in, and then lots of local chapters where you can get to know other people. So I think that whether it's ACG or some other organization, I think there's some great opportunities to learn more about the deal making space, and certainly ways to come together and find opportunities if you're looking to, club a deal, or, you're an investment banker, private equity, or looking to go in that route. I do think there's organizations like ACG that are really beneficial to the market.
That's great. I'm glad you did that because I actually have not personally been involved with ACG, but I've heard some great things about it, and I should probably.
There's an LA chapter, Corey. You could even go stay local.
It's funny because I'm in New York chapters of everything else. I'm president of the National Speakers Association chapter. I was in the Entrepreneurs Organization New York chapter, but because I was always back and forth, and that's sort of where my base is. But I did not anticipate having 8 months straight without getting on a plane in LA. Not that I mean, it's been a good, it's been not a bad place. Okay, great. And then if people want to reach you in terms of your core business and find out just more about what you do, what's the best place for them to do that?
Yeah, probably the easiest thing and easiest to remember is to find me on LinkedIn. I'm pretty prolific on LinkedIn, and so please look for me there. And you can certainly also send me an email at ShareNett. It's mnelson. Actually, I don't even know what that's embarrassing. I think it's mnelson@sharenet.com. I should know that. I don't email myself that often, right? So I guess going back to find me on LinkedIn.
There we go. Yeah. And Marcia does, she puts out a lot of content on LinkedIn, so you can definitely find her. And that's great. So Marcia, my final question is, I was on the podcast, my highest value is freedom. And for me, that means a lot of things, from freedom from, all people from discrimination and oppression to, the reason I'm an entrepreneur and haven't worked for somebody for, 30 years. What does freedom mean to you, and how does it impact your life and business?
That's a really interesting question. So I think freedom for me is, giving myself and other people around me, I think it's opportunity. So I think freedom really comes from opportunity, because if you have opportunity, you can do whatever you want to do and be valuable and ultimately, I think we all need to be, productive members of society. And we need the freedom to be able to explore who we are so we can do that.
Love it. Marcia Nelson, thank you so much for being a guest on the DealQuest podcast.
Thank you, Corey. My pleasure.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.